Okay, so I'm just gonna tell you the honest truth here in this video, whether you like it or not, because I think it needs to be said in order for you to maximize the potential opportunity that is in front of us. Some of you guys, most of you guys, are not gonna like this video. And that's fine. Believe it or not, I don't make videos so people like them. I make videos to hopefully help people make more money, and, well, it's one of those instances where you're probably not gonna love this video, but it needs to be said. Now, I will give you the long story short version of this, and then we'll break it down, and I'll go over my thesis on why I'm expecting these things to transpire. But I will tell you right now, I'm bullish on markets over the next maybe 1-2 months, maybe 3 months. The election's going to be a little bit dicey, but I think there is a massive delay in the economic data that we are being reported. In other words, I think the economy is dramatically worse off, especially the consumer, than the data that we are getting. So 6 to 12 months from now, things could look pretty dire. But over the next 1 to 3 months, I'm not that concerned about the economic data coming in really bad. In the long story short version of all of this, that would mean that small caps and dividend stocks, value, cyclicals are likely to outperform. That also means big tech, think your Super Six, your Google, Amazon, Microsoft, Apple's, they're probably going to underperform relative to the other areas of the markets that I just mentioned. Now let's break this apart a little bit. And the bottom line really is the Fed doesn't matter. What happens in the markets doesn't matter. This guy or that guy doesn't matter. Okay, at least their opinions. The only thing that matters is economic data. If the economy is good, stocks are going to do really good. Or really, if the economic data is just okay, because it's interesting how Wall Street works. For an example, we had durable goods orders that came in at negative 6.4% last month. That was a really bad number. So if durable goods orders come in at negative 3%, that's going to be okay. Retail sales over the past year have come in at the lowest point, like negative 1.2%. If we're negative half of 1%, that's not that bad, because we've been worse than that in the recent past. So I'm not expecting like super great economic data, but I'm not expecting terrible data either. When we get terrible data, that's when the markets will price in a greater chance of a recession, EPS estimates will come down, and generally speaking, stocks are going to have a rough time. But again, I think in the near term, we're going to get a lot of mixed data, and the markets are going to pay more attention to the Fed cutting rates and what areas of the markets will do well based on that. But I firmly think, call it 6 to 12 months from now, yeah, we're going to be just saying to ourselves, how did we not see this coming? Because I have to be honest with you guys. I work in a restaurant. I've worked in a restaurant since 2017. Now, yes, I make YouTube videos one a day, so I've kind of cut back a little bit. I've had 2 children since 2017 that I take full care of and support their well-being. So I don't work there as much as I used to, granted. And that was back in 2017. But now is the worst period we've ever seen before. And it's not just the restaurant, it's not the quality of the food, it's not the service, it's none of that. And this is a pretty well-off community overall. It's neighboring towns and cities. It is everyone you talk to. It's everything, okay? It's not just the restaurants, it's literally everything that is experiencing this consumer slowdown. Now, I struggle to believe this is only going to ultimately be a consumer-related kind of recession, if you will, because the consumer is 72% of the economy. Like, that's a huge deal. That's not the, the small fry. That's not the small fish. That is the biggest fish in the smallest pond. Okay, that's massive. This will eventually catch up to economic activity and get reflected in the data. Now, with stocks at all-time highs, like, that's not priced in. You're pricing in a pretty dang good next couple of months, and I don't think it's going to be all that good. Even though, yes, I do think in the near term, we could go through a pretty aggressive end of the year rally. I'm more concerned about 2025. And just a little bit more kind of reference to kind of some of the slowdown I'm seeing, even in regards to the labor market. My grandma, she's 66 years old. She was married for 30 years, 33 years, got divorced over the past 2 years. She worked at Subway for the last year and a half, and, well, she got fired because Subway is not doing well. Consumer is not doing well. They're not eating as much, food, extracurricular food, I guess, if you will, that they don't need to live on. That's expensive. And she was recently fired. She's been trying for over a month now to get a new job and cannot get a call back. Now, some of that may have to do with her age. Some of it may have to do with other things, but it's not a great labor market. And you're hearing that from other people as well, that their job security's starting to look a little more dicey, if we can use those words. I mean, even as per Affirm, the buy now, pay later platform, 3 out of every 5 people believe we are in a recession. I would argue 95% or more of the American general populace has no idea what qualifies a recession or not, that it's 2 declining quarters of GDP growth. Ask the average person what GDP means, and they're probably not going to be able to tell you. I think that's hinting at more underlying weakness that perhaps is not being reflected in the data. And I think there is just a massive delay and really just a flawed way of calculating the data, which will eventually catch up to us. I mean, Apollo just said over this weekend, layoffs are currently at record low levels. Warn notices are trending down. The rise in the unemployment rate is not driven by people getting fired. Put differently, we are not in a recession, and it is debatable if the labor market is softening. It's laughable, okay? It's just laughable. Wall Street is so disconnected from Main Street. Like, why does anyone listen to these guys? Like, this kind of real world, I guess, breakdown, if you will, of what I'm giving you here in this video is much more valuable than anything you will hear from anyone on Wall Street. They have no idea what average people are facing. And from what I see, average people are not doing okay. Now, the question is, does the weakness I'm seeing in the economy, or what you are seeing in the economy, get reflected in economic data? Does Wall Street ever realize the pain that people are economically going through? And I think the question, or the answer, is yes. The question really is, when? When does that happen? I think it could take some time. Like, even take a look at this. Seth Golden says, my outlook at year-end 2022 was a soft landing, predicted on healthiest corporate and household balance sheets in history, paired with the second most robust labor and employment market in history. And this was the most probable outcome. Soft landing is now certified. Guys, we're not going to know if we actually had a soft landing, in my opinion, until at least the federal funds rate is at neutral, which is about 3%. At the current forecasted pace of rate cuts, that's going to take almost 2 years to get there. So we're not going to know if we actually have a soft landing for a long time. And Wall Street is already drawing those conclusions. How do you best get ready for this moment where Wall Street starts to come to the realization that the consumer is not holding in, that this period of high inflation, Government suggested inflation around 20%, real inflation probably 40 to 50%, especially in food and other important categories. You know, it's going to take some time for consumers to adjust to that. And we are in the, oh crap, this sucks phase, where a lot of people still think inflation is out of control. When I tell people that inflation's basically gone, they look at me like I'm retarded. Like I got a third eye in the middle of my forehead that I didn't know about. That just kind of reflects to me just where the consumer is. And those are interactions I literally have on a day-by-day basis. So with that said, how do you best prepare for this, okay? That's kind of the bottom line. And I think you can, in the near term, make money on the upside. Small caps, dividends, value, cyclicals. I think Wall Street's going to grow more comfortable with this soft landing narrative that has started to go around a little bit more. And you can see the RSP, the equal weight S&P, ever since July 9th, when I had my 10% correction call that I talked about previously here on the channel. The RSP is up from there about 6% or so. The S&P is up, nowhere even close to that. The S&P is up like 1% and some change. Okay, like 1.2% or so. Ever since I had that rotational correction call of 10%. I made that call on July 9th. We ended up peaking out on markets about 5 days later, went through a 10% correction. Now we're back up. And you've seen that rotational correction. The, areas that I mentioned, small caps, value, cyclicals, they've all outperformed big tech. And I think that will continue to happen until obviously it looks like the economy is slowing down. But I think the best thing that you could possibly do is just have a lot of cash on the sideline. Like, I wouldn't blame you if you had 50% of your portfolio in cash right now. I just wouldn't. The risk is too high to not take advantage of it, but I would also have the other 50% invested in areas that would do very well if I'm wrong, and maybe cyclicals and value and small caps continue to do well, and maybe there's no recession, maybe that never materializes, then I think you still want to be able to take advantage of that. I haven't sold any stocks, just I'm not really buying anything right now. I'm just kind of keeping my monthly deposit coming in and waiting for what will be the inevitable economic downturn. With that said, again, the only thing that really matters is the economic data. But you also have Nvidia, which has such a strong sympathy reaction to big tech. Your Google, your Amazon, your Apples, Microsoft's. Like, Apple's trading at where it is today because of a lot of AI hype that is embedded in it. Apple is not $200, almost $30 per share because they sell great phones. The business itself hasn't done much of anything as far as growth for a couple of years. As far as revenue, they've boosted profitability because they're taking in more interest off their cash. They've become a little bit more efficient. We can make a whole video on that. It's not important. AI is important to these companies. They control collectively 40% of the S&P 500. So whatever Nvidia reports will be important. Nvidia reports earnings Wednesday after the bell. Okay. I've been bearish on Nvidia before. I do think GPUs are a little bit hyped up in nature in the near term. I think GPUs are going to be in literally everything. I think AI is going to dominate the world. Give it 20, 30, 40, 50 years. Really like 10 years, AI is going to be a big part of our lives, in my opinion. But in the near term, I think a $3+ trillion valuation is pricing in really good things happening. I think there's no CapEx slowdown priced into that. And I've been wrong before on Nvidia. Okay. I thought the CapEx slowdown was going to happen a couple of quarters ago. It did not happen. Or at least last quarter, I was pretty convinced we were not going to get some super crazy guidance. We did. At least we got good enough for the markets to like it. We're probably going to get good enough again. We've heard from Intel, AMD, TSMC, all of your important AI companies besides Nvidia so far, and none of them have had really bad things to say. So I don't think Nvidia is going to have bad things to say. Good news is, now that we've kind of been through this Nvidia earnings cycle so many times before, we're going to know when things are bad or getting bad for semiconductors, when the CapEx cycle is slowing down from other companies before Nvidia reports, because Nvidia is always super late to report earnings. I don't think that's this earnings. So I think Nvidia is probably going to report good numbers, raise guidance, and that's going to be a reason for the markets to rally even harder. I don't think Nvidia earnings are going to be bad by any stretch of the imagination. Now, we also have CrowdStrike, Salesforce, Affirm, and Okta. Specifically, I want to see Affirm. Are people starting to default more? That, I think, will be important to the markets. I think it'll be important to myself maybe a little bit more, because Affirm did run that survey where 3 out of 5 people believe we're in a recession. Potentially, they're starting to see a little bit more defaults. Thursday pre-market, you have Best Buy, Dollar General. I think Dollar General could be very important. Eagle Outfitters, Ollie's, Campbell's, Burlington, Birkenstock, 1800 Flowers, and a couple of other names. And then Thursday and after hours, you have Dell, Lululemon, Ulta Beauty, Marvell, Gap, Autodesk, MongoDB, Elastic, and a couple of others. I should mention Tuesday, you have Centennial One, PVH, Box. PVH does I believe Louis Vuitton, luxury brands, and I think that will also be important. But it's really Wednesday and Thursday for your big days this week as far as earnings, and I think Nvidia is just going to be a positive catalyst for our markets, if you want my honest opinion. As far as durable goods orders, that comes out on Monday. Again, last month, I was a little bit off. Durable goods orders last month came in at negative 6.6%. So really bad. Like, this was a terrible number. Wall Street just did not care at all. So I don't know if they're going to care again, because sometimes you just do come in really negative. It's not a good sign, though. So we'll see. We're expecting positive 4%. So you're expecting a big rebound. If we see a big rebound, again, that's going to be positive in the near term for markets, and markets are going to say no recession. But really, anything less than 6.6% negative, if we even come in at 6% positive, you're still negative for durable goods orders over the last 2 months. So keep that in mind in just the back of your mind, no matter how Wall Street reacts to it. You will get the S&P Case-Shiller home price month over month and year over year, and the CB consumer confidence, as well as Richmond Fed manufacturing index, services, revenues, and manufacturing shipments that come out Tuesday, and that's pretty much it. Wednesday, you really don't have too much. You do have Fed Bostic that speaks at 6 p.m., but really that's not important at this point. You have the second estimate for GDP. For Q2, we're expecting 2.8% again, so a very strong number. If that gets revised lower, that's going to be a problem, but not really expecting it will. Initial jobless claims comes out Thursday, expecting 234,000. Again, not really expecting much of a change. Last week was 232,000. Wall Street would be just fine with 234,000. I'm not expecting any big upside surprise there either. Fed Bostic speaks at 3:30 p.m. Thursday. Friday, you're going to get PCE. So core PCE month over month expecting 0.2%. Personal income month over month expecting 0.2%. Income rising will actually be a really good thing for markets. So that could be good news. Personal spending month over month is expected at 0.5%. That's where I think we could get the first negative surprise of this upcoming week, because I don't know if personal spending is going to come in positive 0.5%. What I'm seeing would suggest otherwise, but maybe there's some seasonality that could come into play there. It's not too far-fetched. We could get a really good number, but personally, I think we could be in for a downside surprise there. And personal spending, just like retail sales, it's one of those data points that tells you about the consumer, about how they're spending money, and it definitely will affect the path of the Fed funds rate. It will move around your treasury yields. It will be a big catalyst, whereas personal spending, is not really a big catalyst during a normal market. In the grand scheme of things, I actually think this upcoming week's probably going to be a pretty good week. Again, like we've seen from Jackson Hole in 1995 and 2007, whenever the markets are convinced of a soft landing like they were in 1995 and 2007, markets tend to do well after Jackson Hole. We've only had 2 years where Jackson Hole has actually been a positive catalyst. Jackson Hole tends to give you a negative return of almost 3% the day of Jackson Hole and the next trading day later. So historically, Jackson Hole is very negative for markets. But when you're expecting a soft landing and you get this victory speech from the Fed chair, this time it's Powell, it was Greenspan, and I forget who it was in the 95 era. Maybe it was Volcker. I forget who exactly it is. But anytime they give that victory speech on inflation, you tend to get a positive reaction in markets. And this is not what a lot of Wall Street is going to tell you, but you're probably going to see a follow through upside move just from Jackson Hole alone. Okay. Now, whether or not we ultimately go through a soft landing depends on the economy. It depends on other things. And yeah, maybe this is 2007. Maybe it's 1995. It's really hard to say, and I don't think we'll know that for probably the next couple of months. And that's why I think in the near term, we're set up for a larger rally. Okay. I think there could be quite a large rally from here, especially in small caps, values, cyclicals, interest rate sensitive names. But you do want to be a little careful, a little on the defensive side, again, over the next 6 to 12 months. I do think the next 1 to 3 months, political uncertainties are going to come in. That may or may not affect the markets in a negative way. Historically, it does. It doesn't have to. But it's really about the economy. And when the economic data turns is when you should probably position a little bit more defensively. Until then, I think you kind of have a green light here in the near term. But I want to caution everyone just being too bullish, right? I don't think this is 1995. I also don't think it's 2007. I do think there will be a growth scare if we do go into a recession. That's a bigger problem, but I do think there will be a larger growth scare. And I do think we will get closer to a recession than not. And that's when you're going to get a much, much better buying opportunity in markets. And that's where your fortune can ultimately be made. So I think it's best to prepare for that now rather than not prepare at all. So let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. Hit the like button as well as subscribe to the channel if you made it to the end of this video. You guys have a great rest of your day, and I will see you in the next one.